Welcome, everybody. Steven Sitkowski here. Glad to have you for this week's edition of Market Insights. It's been kind of a tough go, hasn't it? I mean, August was ugly. September was ugly. Last week, all the indexes were down. But I think I'm going to have some encouraging words for you today. It is October the 23rd. And happy to share. First of all, I want you to know that everything that we do here is for educational purposes only. It is not intended as investment advice. So when one is considering the financial markets, what do you need to be aware of? Well, the fundamental influences that are impacting the market, we'll talk about those. Overall market trend, we're going to look at that. Various sectors of the market and how they're performing. And then you start digging into individual stocks. So let's begin with what's moving the market. 30% of the S&P 500 companies, they are reporting this week. So is that a potential market mover? You bet. Last week it was 11%. And some of the biggies are reporting, and I'll show you that list here in a little bit. The 10-year Treasury briefly top 5%. Market does not like that. Higher interest rates generally mean lower stock market. Geopolitical tensions are escalating in the Middle East. I'm not a political animal, nor am I an expert on what's happening in the Middle East. The war is atrocious. And don't forget, we have the war in the Ukraine. And then there's the Chinese threat in Taiwan that, frankly, I don't think will materialize. If that does, all bets are off. 10-year Treasury is now at 4.899%. Let's call it 4.9%, just a hair away from 5%. Oil's pretty steady at $87.15 a barrel. What do we want to watch this week? Nothing going on today. Tomorrow, we have the Case-Shiller Home Price Index coming out. We have the Flash Services PMI and the manufacturing. So it's going to let us know sort of the state of the economy. On Wednesday, we have new home sales, not a market mover. Thursday's a different story. GDP comes out. So that will be interesting. Forecasted at 4.5%, which is terrific growth. Initial jobless claims, that moves the market. Expecting 206,000 new folks filing for unemployment. Last week came in 198,000. So the labor market continues to be tight. And I don't think anything else is going to move the market. On Friday, the all-important PCE, personal consumption expenditure, that's the inflation number, along with the core PCE. Tell you what, Fed's going to be watching that number. They always do. So a lot going on this week for you to keep your eye on. Last week's heat map, ugly. Couple of winners, Abbott, PG, Coke. Netflix had a great earnings announcement. Same with AT&T. McDonald's, Lockheed Martin. That's related to the conflict/war. Most everything else was red. Here's your year-to-date heat map. There have been some fantastic opportunities. NVIDIA up 190% for the year. Meta 159%, Tesla down to 71%. That was well over 100% at one point. Amazon about 50%, Microsoft and Apple both over 30%. So like I said, lots of opportunity to make money, but notice there is more red up here than green. So if you were a skilled stock picker, you've had a great year. If you were not, there's a potential that even though the overall market has been up, you may have lost money. Market breadth for last week, I always like to look at the number of companies hitting 52-week highs versus lows. It was a bloodbath. 85 new highs, 559 new lows. That's on the New York Stock Exchange. On the NASDAQ, 103 to 886. Yeah. In terms of advancers versus decliners, 732 to 2,278, 3-1. And about 3-1 in favor of the decliners on the NASDAQ. So we have not pulled out of this 2-month swoon by any stretch, but we ought to moving forward. Total returns. So the top 50 out of the S&P 500, 50 biggest companies, they've done great. They're up 24%. You get down to small cap, they're down 3.5%. So we have what is known as a bifurcated market. Depending on which part of the market you're in will determine whether or not you've had success this year or not. Bond values are getting absolutely crushed. We have rising interest rates, causes existing bond values to go down. A lot of people aren't aware of that. And they're surprised when they look into their account, like, how am I losing money on my treasuries? I thought they were backed by the full faith and credit of the U.S. government. They are, but their market price is not. Earnings estimates continue to improve, so they came down and then moved up a little bit, and now they're scheduled to move higher throughout. Earnings are the mother's milk of the stock market. Investors are dealing with another drawdown. Could be a good opportunity to strike. Percentage of stocks above their 200-day moving average, abysmal. But that's generally what happens before the market goes higher. The VIX, which is the volatility index on the S&P 500, is climbing. No big surprise there. October is the most volatile month of the year. Investor sentiment right now, we're kind of split, Bullish versus bearish. Look at this, 34.1 compared to 34.8, and about 31% are sort of neutral. So evenly divided. Then the question is, because this would be the next big catalyst, is the Fed done hiking rates? There's now a 99.9% chance that on November the 1st, rates will stay the same. Now, it's not just what the Fed does with rates, it's also what they have to say. On my birthday, December 13th, there's an 80% chance as of right now that rates will hold. I don't think the percentage is that high. Just depends on how the data comes in between now and then. So the current forecast is hold until June, and that's when we should get our first rate cut. I don't see it. I see the first rate cut probably in the area of September. The reason for me saying that, the economy is still too good. Inflation is still too high for the Fed not to act, in my opinion. I hope I'm wrong. Earnings this week. We got a lot of biggies. Coca-Cola is coming out tomorrow. Verizon, GE, Visa, Microsoft, Alphabet. Tomorrow's a big day in the market. Wednesday, we've got Meta, Boeing, IBM. Hilton will let us know what travel looks like. Thursday, Amazon, Intel, Merck. Friday, ExxonMobil, Chevron, AbbVie. So 30% of the S&P is going to be reporting this week. Let's take a look at the charts. See how they shape up. Let's look at the S&P 500. So you will notice this rounded top, it bumped up against the 50-day moving average. 50-day moving average is still sloping down. We're waiting for a recovery. Generally, the second part of October, November, December, and January are great for the stock market. And so far today, the market's up a bit. So might this be that pivot point at this support level? Maybe. And we hope so. We're going to have to keep an eye on it. We want to see is the S&P move above its 50-day moving average. That would be encouragement. See this 50-day line flatten out. What about on the Qs? Again, bearish, at least for the time being. This did crawl above the 50-day temporarily and then fell back below, and now it's trying to make another run. It ran into that level of support. Hopefully, we'll see a bounce off of that level. On IWM, this is Russell 2000, which is basically lagged all year. Look at how awful that looks. Cross below the 50, challenge for one day, and then brrr. So generally, the Russell is considered to be a proxy for the economy, which has not been that great. So fingers crossed that this is the beginning of the pivot in the market, but we will let the market guide us. You know, what we hope for and wish for is irrelevant. I've learned that over 40 years. So if you want to know what's happening, you check the charts. All right. Thanks for watching. I will see you next week.